Yeah, we're a country addicted to spending, adding $1 trillion in debt every 100 days. Inflation is the symptom, not the driver. That's the bottom line. And our spending habits aren't going to change anytime soon. And so deficits will get bigger, interest rates will rise further. And, the term in economics, Gibson's paradox, which traditionally speaks to the inverse relationship between real interest rates and the price of gold in particular, in this case, seems to not be as relevant in an environment where gold and silver prices are not aligned with their usual drivers, in particular the 10-year treasury yield and strong dollar. Because as Vince will often say, they just want the metal. And I think India just wants the silver. China just wants the gold. Of course, I'm generalizing there. I think China is a big buyer in silver as well. But, you can, and let's say there's empirical evidence to that showing that in silver this morning in Shanghai, the market opened up, limit up, and opened up at $35.38 an ounce. But on the Shanghai Futures Exchange, it opened up 8% limit up on Monday morning. And so when you talk about the drivers that typically would spell a reversal in the price of gold, a strong dollar, strong interest rates, in this case, and an inflationary agenda that seems to be running out of control, which would speak to higher rates for longer. It doesn't matter. I think that's really what's different this time, is that the pursuit of non-dollar denominated liquidity is outpacing the demand for dollars in U.S. treasuries. Said the exact same thing, just differently not in the same words, but the same ideology for 2 years now, that's what happens. The little by little, the logarithmic decay, the chipping away at the hegemony of the dollar, all of these countries that are not Western friendly in the Southern Hemisphere chipping away at the settlement status of the dollar, trading in local currencies, replacing those local currencies with gold and oil in terms of excess reserves that normally would wind up in treasuries. That little by little by little by little, the debasement of the settlement and the reserve status of the dollar is growing much more profoundly. And I think this is a situation where when you talk about rising prices, look, if you spend $100 every second of every day, 24/7, it would take 1,970 years to print just as many dollars as we've spent in 1 year, over $6 trillion or created in 1 year. The level of inflation that was created by money creation, the classic definition of it, is exactly what we should be expecting. And that hasn't even flushed its way through the system yet. The debasement or the falling dollar is a reflection of the weaponizing of the dollar, is a reflection of the fact that these countries no longer trust us. It's like a glass broken into a million pieces. When you break it, you can't put it back together, at least not very easily.
We are in an era of unprecedented financial manipulation and uncertainty, where understanding the value of tangible assets is more important than ever. Let's start by acknowledging a fundamental truth. We are a country addicted to spending. Every 100 days, we add $1 trillion in debt. This reckless spending habit won't change anytime soon, leading to ever-increasing deficits and rising interest rates. Inflation is a symptom, not the driver, of this economic malaise. The real issue is our insatiable desire to spend more than we have, creating a vicious cycle of debt and devaluation. In economics, there's a concept known as Gibson's paradox, which traditionally speaks to the inverse relationship between real interest rates and the price of gold. However, in today's environment, this paradox seems less relevant. Despite strong interest rates and a robust dollar, gold and silver prices aren't following their usual patterns. Why? Because the demand for these metals is now driven by a pursuit of non-dollar denominated liquidity. Take India and China, for example. These countries are massive buyers of gold and silver, not because of traditional economic indicators, but because they want to hedge against the dollar's instability. Just recently, the Shanghai Futures Exchange saw silver prices surge to $35.31 an ounce, opening limit up at 8%. This move underscores a significant shift in how these metals are valued globally. In the past, strong interest rates and a strong dollar might have curbed the price of gold. Today, however, the opposite is true. The relentless printing of money and the resulting inflation are creating an environment where gold and silver become more attractive. We're witnessing a decoupling from traditional economic indicators, with non-Western countries increasingly trading in local currencies and using gold and oil to back their reserves. Consider this. If you spent $100 every second of every day, it would take 1970 years to match the $6 trillion we printed in just 1 year. This level of money creation inevitably leads to massive inflation. The falling dollar is a reflection of the weaponization of our currency and the growing distrust among other nations. When trust is broken, as it has been with the dollar, it's nearly impossible to restore. The ramifications of this money creation are profound. Over the years, low interest rates created huge distortions in asset prices. As rates rise, we face the prospect of stagflation, a period of stagnant economic growth combined with high inflation. The demand for dollars and treasuries is waning. Countries that once saw the American financial system as the gold standard are now seeking alternatives. As deficits grow and interest rates rise, we're witnessing a global shift away from the dollar. Higher prices, higher taxes, and lower economic growth are the new norm. The Federal Reserve's policies have created a precarious situation where the stability of the dollar is in jeopardy. The once almighty dollar is losing its luster as countries diversify their reserves with commodities like gold and silver. Now let's talk about the potential for an all-at-once moment, a sudden and massive dumping of dollars and treasuries. This scenario hasn't happened yet, but the slow, methodical reduction in foreign holdings of U.S. treasuries is a warning sign. China, for instance, has reduced its holdings from nearly $3 trillion to $750 billion. This trend reflects a growing reluctance to hold U.S. debt. When the all-at-once moment occurs, it will shock many. Most people are unaware of the rising prices of silver and gold because they are not paying attention. The general public remains asleep while the financial landscape shifts beneath their feet. Higher prices, higher yields, and continued de-dollarization are inevitable. In this environment, the value of tangible assets like gold and silver cannot be overstated. These metals offer a hedge against the instability of fiat currencies. As traditional financial systems falter, commodities become a safe haven. Gold and silver in particular have a storied history of preserving wealth in times of crisis.
And so what you are seeing is a byproduct of the same time of the ramifications of massive money creation, most of it done over the years where interest rates were near zero, creating huge distortions in asset prices. The end of it is rates were still rising. Well, they were still creating tons and tons and tons of money, which is going to fuel the inflation. And as rates rise, maybe that we head towards that stagflation. But the point of it is that I think there's a disconnection now, whereas in years past, everyone wanted dollars, everyone wanted treasuries, everyone wanted to be part of the American system. And that system no longer, I think, is inspiring as many participants as it once were. So yes, I see this exact same way that Rafi does, maybe hyper-stagflation, higher prices, higher taxes. What did the knucklehead say? If he wins again, he wants to raise capital gains to 44.5%. He wants to raise income taxes. He wants to impose a mandatory tax on unrealized gains for the very wealthy, higher taxes, higher inflation, little or no economic growth. And I do see a time where the world finally, that all at once moment triggers, and there is a dumping of dollars, there is a dumping of treasuries that accelerates. Not just what we've seen slowly and methodically and orderly, where China has gone down to 750 billion from over 2 trillion, almost 3 trillion. That's the little by little by little. The all at once hasn't happened yet. But what I do think, when the all at once happens, it will shock people. Like to Rafi's point, no one knows that silver is over 30 unless you're in our camp. And it's a very big deal for the people in our camp. Most people wouldn't know a silver dollar if it fell on their foot, or the ramifications of rising silver, what it really means, or massively rising gold and de-dollarization. All of this stuff we focus on, the public is asleep. And so I see the exact same thing. Higher prices, higher yields for longer, and continued de-dollarization and de-treasurization that we continue to foster. Where Janet Yellen has the nerve to tell China, if you give 1 penny to Russia to aid their war machine, we're gonna sanction your banks, your companies in Beijing itself. Don't worry that we've given 200 billion to the Ukraine with no congressional oversight. That's our business, and we're the world reserve currency. This is I think that's exactly what will happen now. To your point, what does it look like? Who knows? I mean, yeah, I think it won't last forever, but there could very well be a time where things of value are used to barter, because who's going to want dollars in an environment where no one wants to hold them for any significant amount of time whatsoever?
As we delve deeper into the current economic situation, it becomes evident that the traditional metrics for valuing gold and silver no longer hold the same weight. The global pursuit of non-dollar denominated assets is outpacing the demand for dollars and U.S. treasuries, reflecting a seismic shift in the financial landscape. This shift is driven by a desire for security and stability in an increasingly volatile world economy. For years, countries have been gradually reducing their reliance on the dollar. China, for instance, has methodically decreased its holdings of U.S. treasuries from nearly $3 trillion to $750 billion. This significant divestment is not an isolated incident, but part of a broader trend towards de-dollarization. Nations are seeking to insulate their economies from the uncertainties and risks associated with the dollar-dominated financial system by accumulating gold and silver. The trend towards de-dollarization is more than just a theoretical concept. It has profound real-world implications. The massive creation of money during periods of low interest rates has led to significant distortions in asset prices. As interest rates rise, the true impact of this money creation is becoming more apparent. Inflation is one symptom, but the deeper issue is the erosion of global trust in the dollar as a stable store of value. The global community is increasingly questioning the sustainability of the U.S. economic model. The sheer scale of debt accumulation and money creation is unsustainable in the long run. As Andy Schectman highlights, the traditional safe havens of gold and silver are becoming more attractive as hedges against economic instability. The shift away from the dollar is accelerating, and precious metals are at the forefront of this transition. In this new economic landscape, gold and silver are not just commodities. They are crucial stores of value and symbols of financial security. Their prices are influenced not merely by interest rates or the strength of the dollar, but by global geopolitical dynamics and economic strategies. As nations like China and India continue to accumulate these metals, they are signaling a move towards a more diversified and resilient financial system. This shift towards gold and silver is driven by several factors. Firstly, the geopolitical tensions and economic sanctions imposed by the U.S. have made other countries wary of the dollar. Nations like China and Russia are seeking to reduce their exposure to the dollar to avoid potential economic repercussions. By accumulating gold and silver, they are building financial resilience and reducing their dependence on the U.S. financial system. Secondly, the economic policies of the U.S., particularly the massive stimulus packages and low interest rates, have led to unprecedented levels of money creation. This has fueled inflation and created significant uncertainties about the future value of the dollar. In response, countries and investors are turning to gold and silver as reliable stores of value. These metals have a long history of retaining value in times of economic turmoil, making them attractive alternatives to fiat currencies. For investors and individuals alike, understanding this shift is crucial. The value of gold and silver is tied to their scarcity and historical role as safe havens. In times of economic uncertainty, these metals offer a hedge against inflation and currency devaluation. The demand for gold and silver is a reflection of a broader desire for stability and security in an unpredictable economic environment. The increasing demand for gold and silver is also evident in the actions of central banks around the world. Many central banks have been diversifying their reserves by increasing their holdings of gold. This trend is expected to continue as countries seek to strengthen their financial positions and reduce their reliance on the dollar. The actions of central banks are a clear indication of the growing importance of gold and silver in the global financial system. Moreover, the investment community is also recognizing the value of precious metals. Investment in gold and silver ETFs has surged, reflecting the growing interest in these assets. Investors are seeking to protect their portfolios from the risks associated with traditional financial assets. Gold and silver offer a hedge against market volatility, and provide a safe haven in times of economic distress. The growing importance of gold and silver is not just limited to large investors and central banks. Individual investors are also turning to these metals as a means of protecting their wealth. With the increasing availability of gold and silver investment options, such as coins, bars, and ETFs, it is easier than ever for individuals to include these assets in their portfolios. The accessibility of gold and silver investments allows individuals to safeguard their wealth against economic uncertainties. In conclusion, the current economic environment is characterized by unprecedented levels of debt, inflation, and a gradual move away from the dollar. As nations and individuals seek alternatives, gold and silver are emerging as key players in this new financial order. Their value lies not just in their price, but in their ability to provide security in uncertain times. For those looking to safeguard their wealth, investing in these precious metals is a prudent strategy. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.